Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, we need to talk about Google's decision to lay off 12,000 employees and what that means for the stock market as a whole and what it tells us about what to expect in 2023. All right, so first, again, it's always an unfortunate situation when I have to explain what is going on when people get laid off. It's never a fun thing, even though the stock was up about 5% as a result. I understand the math behind it. If 12,000 people are expensive, right? That's going to cut down your expenses. You're going to look more profitable. I hate that the stock went up today because of that, but that is the reality of the situation, and it happens almost every time that a major company announces layoffs, unfortunately. But what does this mean for investors, and how should we use this information moving forward in 2023? Well, first, this is a result of 1, higher interest rates, and 2, what happened 3 years ago. And that is the thing I think that the biggest lesson that we should understand is that what works in 1 year doesn't always work in the next year, but also what happens in the past can still impact the future years after the fact. Because notice, in 2020, who was hiring the most? Who was hiring aggressively in 2020 at the height of the pandemic? What were the services that we used? What stocks were really taking off back then? They were primarily the stay-at-home stocks, right? I've mentioned this a little bit before, but Amazon was hiring aggressively. Alphabet was hiring aggressively because we were all online. We were using, whether it was a new tablet or it was internet service, whatever it was, the Chromebooks in the case of Alphabet, they had to hire more people to take on that higher level of demand. Again, Amazon, buying stuff left and right from Amazon, and they had to get those packages to you within 2 days. Well, if you had to hire, and I'm just making up a number here, 500,000 people because of the pandemic and people are staying home, what happens if you still have those 500,000 people and you're still having those expenses, but people are ordering less because they're going outside more, because they can go to the store a lot more? They had to adjust their workforce to meet the lower supply and demand that they're dealing with. It is an unfortunate situation, but it is basically comes back down to supply and demand. And this is almost from the words of the CEO, that the reality of the situation of what we have today in 2023 is not what it was in 2020. This is an adjustment to that. Now, the other part of the context is Google does employ 186,000 people, so this is about a 6% decrease in the workforce. Again, that is significant, especially for those who have gone through it. However, it is not quote unquote massive in terms of what we have seen. Take Twitter, for example, where they allegedly laid off half. So comparison is not as bad unless you are going through it, which I do have sympathy for. The other thing too is tech as a whole only represents about 2% of the labor market. That's not to downplay the significance of it, but it does show us that yes, they have an outsized impact on the stock market, not necessarily the labor market, which is important because in 2 weeks, Google, as well as a lot of other tech firms, are going to tell us how well they did in 2022. Here's where things get really interesting. So we've talked about this, I feel like we talk about this every year, 4 times a year to be exact. Google, Alphabet, Amazon, they all, and Meta, for example, or so you can throw them in there as well, they all report their earnings in the same week. Now, those 4 to 5 companies represent close to 20% of the entire S&P 500. When they do well, the stock market does well. When they don't do well, the stock market tends to fall. That's just how it is. For example, again today, stock market was up quite a bit. That is because Google was up 5%, right? The market just really kind of tags along and goes in whatever direction those companies go. Well, here's the thing. In 2020, the net income for Google, the profit they had, was about $40 billion, okay, in 2020. That jumped from $40 billion to about $76 billion in 2021. Well, if you had to cut 12,000 people today and you're announcing earnings in 2 weeks, I can only assume that you did that because your profitability was not as high as $76 billion. I would venture to say that you wouldn't have cut those people unless your numbers were not as good as what you would expect. Now, that is something I will be paying a lot of attention to in the next 2 weeks, but that tells me that the math ain't mathing, right? You had to cut those people for a reason. It's probably because you weren't as profitable as what you expected. Because you can't go from 2019, it was actually 30 billion, then 40 billion, then 76, and in 2022, once you start to combine those numbers, again, I would assume that it had to be lower. Now, the other half of this is if their earnings are lower, that means they're likely either spending too much, which is why you cut, or they're not bringing in enough money from advertising. Why would that be the case? Well, I can only assume because people aren't, and by people I mean businesses, aren't spending enough money on advertising. If a business is not advertising, what does that mean? They are contracting, right? If I don't have money for advertising as a business, I'm not looking to make a whole bunch of money, right? I'm looking to cut, I'm looking to be more conservative, and that may be a result of rising interest rates. All of this is, I know it's a really large painting, but this is why so many are concerned about an overall, I don't want to say shutdown, but an overall recession in 2023. Most banks have thrown out the word mild recession, and this is all why things are connected in that way. So, you as an investor, what is it that you need to pay attention to, and what should you be doing right now? You should continue to play the middle, in my view. That means defensive stocks are still likely going to work. A lot of the stuff that we had talked about last year, especially I would say from March to about December of last year, you can go back and review all of those videos. The majority of those stocks and strategies should still work, because if we are going into a mild recession, if interest rates are going to continue to rise, which in both cases most people expect, those are going to be the quote-unquote safest places to be, because we are still on somewhat of a shaky ground. Because if businesses are spending less, and we know the entire economy is based on spending, people are losing jobs, it starts to be a little bit of a cycle, and it's really a question of how severe would the economy slow down? Is it going to be very, very rough, or is it going to be, again, as the banks say, mild? That's the thing that we need to pay attention to. It's one of the reasons why I'm investing in a company like Smucker's, right? SMJ. It's very boring. It's very defensive. I think people are going to continue to eat peanut butter and jelly. I don't know what's going to happen in the tech space. I don't know if Tesla is ever going to make it back to where people think it should. But I do know people are going to keep eating peanut butter and jelly. I know people are still going to be eating chocolate with Hershey's. Those are two things I can bank on with relative certainty compared to some of the other things that used to work that are no longer working right now. So keep your eye on things like that, and also start to piece together the puzzle for what we think is going to happen in 2023. My guess and my estimation is going to be that is going to be very similar to what we saw in 2022. So if you made a mistake in 2022, I did too, right? I'm not judging you. Everybody makes mistakes. But if you made a mistake and invested very aggressively in a bunch of tech stocks, I wouldn't do that in 2023. Okay? Based on what we know, that's probably not what I would do. Now, if you want to continue to buy Apple, I'm holding Apple. I'm still holding Microsoft. I haven't sold a whole bunch of my tech stocks. But if you want to just continue to invest aggressively there, I don't know if that is the best thing to do right now. But don't make the same mistake twice. I think that's the most important thing. If you're investing in stuff that was not profitable and they were losing money, not what I would do in 2023. Like, why would you be investing in Peloton? I'm sorry, Peloton. I know it's shade. But that's not what I would do in 2023. We've seen that in the last 2 years. They're just not the best strategy. So pay attention to what is going on. Start to piece those things together, which is why you want to like and subscribe, because we piece this together Monday through Friday. Okay, that's why we're here. But aside from that, that is where I think that the playbook is going to be. It's still going to be Hershey. It's still going to be Smucker's. I don't believe that's going to make you 50%, but I do think it's going to protect your money a bit better than what we have seen in the last year. It feels like 18 months, but definitely over the last year. Now, the last thing I'll say is this. Tonight, okay, inside the members only, we're going to do a breakdown on a relatively new tool, a tool we haven't covered before, I'll say that can help you to kind of understand what stocks will work and what stocks may not work. I say that because we talk a lot about profitability, and we talk a lot about companies that have that net income, the money you have after you pay all the bills. That is going to become and has become increasingly important in a space like this, because when interest rates rise and money is not free anymore, like it felt like it was in 2020, investors and the stock market as a whole start to really pay attention to the numbers. Okay, you start to say, well, you know, I know you wanted to do, let's take Revlon for example. I know you wanted to produce all these cars, blah, 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 but I'm throwing a number out here. You're $50 billion in debt, and you're going to be paying a lot more money, right, as interest rates rise this year. probably not going to invest in a company like that. Okay, that's not me saying no to Revvion. I don't know what their actual debt number is. I'm just giving you an example here. So you need to be able to quickly identify whether or not a company is profitable, whether or not it makes sense, as opposed to gambling and hoping that something's going to work. So that breakdown is going to be inside the members only tonight. So you want to make sure that you join it. We do exclusive videos every single week. All right, that is it for me today. I will talk to y'all on Monday. All right.